And we're back.
Yay, welcome back.
Episode 2. I felt like the last episode was a bit formal, and now we're trying to get a little bit into the groove of things. So if you are still with us, I just hit the microphone.
Yay.
If you're still with us, then thank you for coming back. That first one was a little bit
we're getting the jitters out.
boring.
We're learning.
We are learning. This is a new adventure for both of us. So, we are still kind of on the topic of credit. There's so much information out there about how to use your credit, how to make it better, what affects your credit negatively. Yep. And so this is how we're able to kind of share the information that we have and get it out to the public in the quickest way. Yeah.
Want to give you guys something with a little bit of value, and hopefully you guys can learn from it. It helps you in any way that you need. But today we are going to talk about what types of credit there are and why they matter.
Yeah. So there are two different types of credit. The first one we're going to go over is revolving credit. There's also installment credit. Those are the two main types. So revolving credit, what that is so revolving credit would be things like a credit card, a retail card. So if you have a Target card, I know every single time I go to Target, they're always ask me if I want to sign up for a credit card, and I always say no.
Yeah, Cabela's, any major chain is going to try to get you to get their card.
I mean, unless you really know what you're doing and have a good grasp on how to use credit cards to your advantage, I would just they really try to hook you in with like, you can save 20% if on your order on your checkout today if you sign up for this credit card. Don't do it. No, it's not a good idea.
Keep your credit cards down to like maybe 2 or 3 cards total, and that way you can keep it all scheduled and paid on time and all that. That's my advice. Is just keep it simple. And
you are speaking as if the people watching or listening, already have a good idea of how to utilize credit. Right. And I'm going to say, if you have never had a credit card before, let's start with one.
Yeah.
Let's start small, and then we'll build it from there.
Right.
So revolving cards would be your Target card, Best Buy, gas cards, and just your typical credit cards. The things about revolving credit cards, there are no set payment schedule. So you can pay as much or as little as you want to. Now there is a minimum payment that you have to make every month, but it might be very, very small. It may even be less than what the interest is charged on that balance. So there are no set payment amounts, or there are no set monthly payment schedule. You can pay as much or as little as you want to at a time, as long as you pay the minimum balance or minimum amount. And then the other main things is that accounts, if you have a credit card and you have a bill of $500 and you pay off that bill in full, the credit card's not going to cancel. It's not going to close the account.
Right.
So you're just paying it off in full, and that account stays open. It's revolving.
That line of credit doesn't close.
Right.
That's the main takeaway in that.
And the last thing about revolving credit is that they tend to have slightly higher interest rates, and not slightly, substantially higher interest rates. Your standard credit card is probably going to run you 26% interest, which is astronomical.
Yeah,
huge amounts of interest.
That's why that minimum payment is such a big deal, is because your interest can literally be more than what you're paying in for your minimum payments. So if you're only making the minimum payments, you might end up paying double or triple the amount of whatever it is that you bought on your credit card in the end. So those interest rates are very, very high. And I'm going to turn it over to Dirk. He's going to talk about the other type of credit. Yeah, so the other type of credit is installment credit. This could be like your car loans, your mortgage, student loans, that type of credit. These have specific terms and repayment schedules. The account does close at the end. When you pay it off, say you pay off your student loans or your car loan, that line of credit is off. So we get that a lot, where people will be, getting ready to buy a home with us, and they're like, my credit's great. I just paid off my car. Well, that's going to affect your credit report, because now one line of credit that you had for, say the car was $20,000, If you pay that off, that line of credit is now closed on your credit report.
Yeah, and I think that specifically, we may address how that can affect your credit score in another episode, because the intricacies of how to use credit to your advantage, and what happens when you, let's say, pay off a line of credit that can everyone thinks if I pay off my car, that's good.
Yeah.
Right? Well, you can oftentimes see your credit score go down when you pay off a car loan.
Your overall, like how much credit you have is all of the lines of credit you have put together, and how your utilization ratio is how much of that you're using. So like I said, if you close down a $20,000 credit line for a car, that takes off $20,000 from your overall credit.
So just to keep it more, not to confuse our viewers, let's maybe talk about, outside of closing down, that car loan. Mm-hmm. So installment credits are car loans, mortgage loans,
student loans.
Yeah. They all have set monthly payments. You know exactly how much you have to pay per month. You pay it on time every month, and when you pay it off, that line closes. What are the other differences between that and revolving?
You also have lower interest rates usually. So that's a good part of it. Is it's more of a structured, payment schedule, all of that, plus lower interest rates. So
okay,
easy breakdown.
Yeah, cool. I mean, I would hope nobody's getting a car loan at 26% interest.
Yeah, don't do that. Don't do that. Okay, so the next bullet point we have is why credit scores matter. So the businesses want to check your reliability before they offer you a service like a cell phone, car loan, anything, even a mortgage. They want to see how responsible and how reliable you are. So your credit check, your credit report is checked every time you open a utility account, you apply for a new car loan, you get a cell phone, even an insurance policy, your credit can be run. So the idea behind this is to credit's like a game. You have to learn the rules of that game, how it all works, and then you know how to play it and use it for your own, forward movement.
So why credit matters, I think, a lot of people ask this. When I was in me speaking about me personally, when I was in my 20s, I did not care. I didn't care about my credit. I didn't track it. I didn't. I think I had an American Express card, and I ran up a huge bill, and then I didn't pay it for a few months. I know that's so bad. I ended up settling with them, but that negatively affected my credit for a long time. Everybody, not everybody, but a lot of people in their younger adult years just don't really pay attention on how important credit is, and you will discover later on in life how important that credit report and that credit score truly is. I mean, good credit rules the world. If you haven't heard that saying yet, you've heard it now, and you're going to hear in the future. The better credit score you have, the lower interest rates you're going to pay
on everything.
So on everything.
You get way better options and offers the higher your credit score is, because it shows that you're responsible with money. So I mean, if you have a higher credit score, you can pay lower interest rates. You can pay less for your utilities, your insurance, all of that stuff. It's going to show that you're reliable. So that's people are more willing to offer you services or loan you money that way.
Yeah. Well, so so we've talked about the types of credit. You've got revolving and installment credit. And I want to talk about the types of borrowers. We have transactors and revolvers. Mm-hmm. And so transactor borrowers are people that, let's say they have a credit card with $1,000 limit or a $10,000 limit, and they're using small amounts, and they're paying it off in full every month, and they're only, they're spending within their means. So they're, using it to buy gas and then immediately paying it off, using it to buy groceries, immediately pay it off. That's called a transactors.
Yeah, sorry, that's a transactor.
Well, that's a tongue twister. There is a myth and that people think that they have to pay interest to boost their credit score, and that is just not true. No. If you are paying off your debt, your credit card balance every month, then the reality is you could never have to pay interest on that as long as you're paying it off.
Yep.
The other type of borrower, which are revolvers, I'm going to let Dirk talk about that, then they would end up paying more interest than a transactor would.
Right.
And my last point is that being a transactor, using small amounts, paying it off every month, being responsible with the money that is loaned to you, is the best way to build positive credit.
Yeah, I agree 100%.
Living within your means.
Yep. So the next type of borrower is a revolver. And revolvers, they spend large amounts of available credit. So let's say you rack up a huge credit card bill. You get approved for $1,000. You take out that $850 television we were talking about. That's more of a revolver. So then you only pay the minimum amount due for that month, leaving a revolving credit or a revolving balance on your credit card. And then that carries over to the next month, builds interest, carries over to the next month, builds interest. That racks up very quickly. So this is how credit card companies make their money. They make their interest off of a lot of people that live like revolvers. They charge large interest fees on remaining balances. So if you consistently spend more than you pay, your levels of debt are going to skyrocket. And that's how most Americans get into credit card debt, is because they go, oh, I have $1,000 that I can spend. You have $1,000 of credit line. Doesn't mean you need to spend $1,000, but if you do spend $1,000, it means you need to pay back that $1,000 as quickly as you can, or you're going to get hit with that interest.
Yeah, the interest rate or the interest is what keeps people, from being able to achieve financial freedom.
Exactly.
So we come from a personal history of awful credit.
Yes. Both of us had bad credit, and we
made poor mistakes in our 20s,
horrible.
and we spent a lot of years working really hard to get back on top to a position where then we could, buy the house that we're sitting in right now, and help others be able to buy their homes too. So we speak from experience when we are sharing this information.
We learned all these lessons the hard way. We are trying to give back to our community and just kind of coach people on saying, this is what you can do. I mean, even if you aren't in the market to buy a home, this is the type of stuff that helps you just live a little bit better life, keep more of your pennies in your pocket.
Mm-hmm. Paying less interest. Good credit rules the world.
Exactly.
So that's all that we have for today. And I hope it was a little bit more enjoyable than our last episode. We're getting better. And so I hope you guys will stick with us.
Stick with us. I appreciate you guys. See you in the next video.